Hello, everyone. Thank you so much for joining Propelx webinar today. And today we're delighted to have a guest, Jonathan Fish. On the call, he is running a QSBS related services, and he's also an expert in the subject. And of course, today, this is a very popular topic because it matters to not only the founders, but also investors and employees of these companies as well. And today we're going to cover all you need to know about QSBS. And we already have a lot of questions coming in. So we're going to also try to address these questions as much as we can. All right, just a little bit kind of logistic about this webinar. First of all, Jonathan and I and Propelx and CapGain, the organization Jonathan represents, we do not offer tax advice, right? If you really wanted to understand QSBS to its bones, and we suggest you contact your personal tax advisor. We're here just to present some informational, educational information. So hopefully that can help you navigate the landscape a little bit. And also the webinar will be constructed in a way that the first 45 minutes is going to be Jonathan and me, and back and forth. We're going to do a little bit of fireside chat kind of format. And I'm going to raise a lot of questions, and Jonathan's going to address these questions. And many of the questions come from you at the time when you register for the webinar. And we're going to use the Q&A box to manage your questions. So if you have any questions during the presentation, during the conversation between Jonathan and me, feel free to use the Q&A box to put in your questions. But we will manage these questions towards the last 15, 20 minutes. And hopefully we can go through as many as we can. But if we don't worry about it. And we're going to try to provide these answers in writing later after the seminar. And today, this is the agenda. And initially, I'm going to introduce Jonathan and myself and Propelx and CapGain. Then we're going to talk about, what are really the tax benefits for QSBS? What is QSBS? And then what are the eligibilities the company have to meet to be qualified as QSBS? And then we're going to talk about different securities, how QSBS works or does not work on some of the securities. Finally, I know some of you might have the QSBS rollover fund and you're looking to deploy in the next 60 days. We're going to talk about those as well and how do you make these things work more efficiently. Well, first of all, I think some of you might know me. I'm one of the co-founders and head of investments in Propelx. And Propelx is one of the leading online investment platforms. Initially, we started out in the deep tech space and for early stage deep tech investments. But over the years, we have expanded outside deep tech. And we are now doing not only early stage, but also growth stage. And also, we're going to provide alternative investments such as diversified funds as well going forward. And would be lovely to see many of you on the platform, not only investors, but also entrepreneurs who want to raise funding on Propelx. We welcome you to come to us. Jonathan, do you want to maybe give the audience a little introduction to yourself and QSBS?
Yeah, firstly, thanks for having me here, Lishang. And it's been great to get to know you, get to know the Propelx community, collaborate as we have, and there's really a lot of great potential. And so there's a lot of exciting things. To tell you a little bit about myself, Jonathan Fish. I'm the CEO of CapGain Inc. I'm a CPA. I spent about 20 years in public accounting, both with PwC and then Deloitte. And I was working with a lot of venture funds, and that's really where I was introduced to QSBS and saw some of the challenges that folks were having in really substantiating if a company qualifies, if an investment qualifies, and kind of seeing those challenges and all the complexities and the rules. It's funny, like QSBS is a funny topic where it's really like a very interdisciplinary, like it's not just tax, it involves accounting, it involves valuation, law, and it's really kind of bringing all those skill sets together is what we've done through CapGain Inc. And we have a website, qsbsexpert.com. And what we've mostly been doing is working with companies and investors and the venture community to help monitor and manage QSBS and other tax incentives, and make these tax incentives more accessible to people, so that they're only these are great tax incentives that the government's created to help spur economic development and activity, and if they're only so good as people could access them and be able to keep up with the standards, know how to support them, and you leverage them to your advantage. So that's a large part of what we've tried to set out to do.
Thank you, Jonathan.
Yeah, and I should say I have 3 little kids who are all unfortunately homesick today. So if you happen to hear any background noise, sorry about that. I don't think they'll want to join the webinar. They hear a lot about QSBS, but so hopefully we'll be able to move on without a problem.
Well, we're good so far. All right. On this next slide, these are all the questions, audience, you have submitted at the time of registration. And some of the questions came out of the last seminar. If you remember, a couple months ago, we had another seminar about tax incentives and things like that on venture investing, angel investing. And there are a lot of great questions. And Jonathan has done some work in putting these questions into 3 big baskets, right? The first one is kind of eligibility and exclusion. What are the some of the tax benefits are not necessarily included or are included in QSBS, right? And the second pillar is basically as a corporate or the startup, and what are the eligibilities for you, and finally as investors and taxpayers, meaning employees can potentially be in this basket as well once your options exercise options at the time of exit. And how do you look at your eligibility and figure out what's your tax benefits implications, right? So I think Jonathan also came up with some visual slides in the next few slides to cover all these questions, hopefully holistically, right? Because we have so many questions, might not answer every single question. And so feel free to use the Q&A box again if you don't see your question answered, okay? So let's go to the first exclusion section, Jonathan.
Yeah.
So can you just tell us about maybe the QSBS as a whole, in general, what QSBS is, what is the benefit to different stakeholders in the venture business?
Sure. So QSBS has been around for many years. It started in 1993, and as a tax incentive designed to help spur innovation and entrepreneurship, and so it does it through a capital gains tax exclusion. It's currently 100% exclusion, up to a limit of $10 million or 10 times your basis, whichever is greater, and that's for every shareholder. So if you're a partner in a partnership, each partner gets that exclusion level, and but it wasn't always 100% exclusion. It started back in 1993 as a 50% exclusion, and then was increased to a 75% exclusion in 2009, and again up to 100% in 2010, really for investments that were made starting in September of 2010. So the 100% exclusion really started to be realized by folks in late 2015, because there's a 5-year holding period. We'll get to all the requirements. But it started to gain more and more prominence as, post being 100% exclusion. And then with all the liquidity events that started to happen in 2018 and, there around there, people started to realize these gains and benefit from this a lot more, and, and become aware of it, and you try to make sure that their gains qualify. I mean, for us, we get a lot of people who reach out because they either had a QSBS gain or a gain that should have been QSBS that they couldn't substantiate and weren't able to claim the exclusion, or just missed it for some reason, for some of the technicalities within the rules. and people that have kind of want to make sure that they don't miss out on those opportunities again, and so like what actions need to be taken in advance to make sure that's the case. But I thought it would be helpful, with the questions that LaShang brought up, to walk through an example that should address most of the questions about the tax exclusion. Then we'll move on to some of the other areas of what it takes to qualify. So in this example, so we have an investor who purchased two securities in the same company. And so they purchased common stock they invested $1 million. And for that common, the QSBS criteria have been met. The 5-year holding period has been met. And it's in this 100% exclusion bucket. And again, like those exclusion percentages basically came from every time that the law was updated, so it's all based on when the stock was issued. And so if it was issued prior to August of 1993, QSBS didn't exist, and there's no exclusion. And then all the way up to, for stock issued after September 27, 2010, it falls into this 100% exclusion bucket. So back to the example, so the same investor, they participated in the seed preferred round that the company had a few years later, and they invested $2 million in that round. Again, the QSBS criteria, which we'll get to, have been met for this security, except for the 5-year holding period. This security, as we're about to show you, we get to an exit. So in this example, in this exit, both securities are sold for $35 million. And so again, the seed preferred hadn't met the 5-year holding period, but the common stock had. And so what happened, like to illustrate some of what happened, so now you have this $35 million gain. Your cost basis is for all the stock that you had in that issuer. So you have a $3 million cost basis. Again, that affects the exclusion, the ultimate exclusion level. If they had only invested in the common stock, it'd be a $10 million exclusion. It's equivalent to $10 million or 10 times your basis. Since they have $3 million of basis in this issuer or company, they have 10 times the $3 million basis, or $30 million of a QSBS exclusion. So subtracting the 32 million gain from the $30 million exclusion, they have $2 million of a taxable gain, which is tax up the long-term capital gains tax rates. And then you have these potential tax savings for the QSBS portion of the gain. And so what is that really? That's taking this $30 million that otherwise would have been subject to the 20% capital gains tax and the 3.8% net investment income tax that isn't going to be taxed. So that's $7.14 million in savings. And there could be additional state tax savings, but every states handle QSBS in different ways. Generally, you either conform, where the state abides by the federal QSBS rules, don't conform, which those are the states in red on this map, 5 states, or some states partially conform, where maybe they only accept QSBS at the state level if the company is from that state, and situations like that. Sure, a lot of people have heard, and some of the questions centered around, is QSBS going to change? What's the government doing? There are currently no changes projected for QSBS. There was a proposal in the Build Back Better Act, which came out in September of 2021, to curtail QSBS back to the 50% exclusion for taxpayers above $400,000 in AGI, including the QSBS gains. That we participated in a cohort that sought to kind of lobby about this and raise awareness of how this impacts the venture community and entrepreneurial community. But fortunately, just recently in August last month, when the Senate released their version, which is the Inflation Reduction Act, which is ultimately signed into law, a lot of the changes to the tax policy, which were included in the Build Back Better Act, were excluded from what became the ultimate law, and including QSBS. So the QSBS is stayed put, as is, and we hope it continues to remain that way.
Thank you, Jonathan. We have some questions from the audience that I think the slides didn't cover. Let me just go into some of these questions. And
Sure.
the first of all, is QSBS only for US-based company? Does the exemption apply to non-US based company?
Well, both from a investor and company standpoint. So you have to be a domestic US company in order to issue QSBS stock. So we'll get to that in the next section with the company level requirements. And exactly what is a domestic US company is an area that we'll discuss. But it often comes up as well. Well, what if you're a non-US taxpayer? Well, this tax incentive is for US taxpayers, and so generally it doesn't apply to non-US taxpayers. However, there are situations we've encountered where say you're a US taxpayer, but now you move to another country at the time that you have your gain. Generally with capital gains, the tax is determined based on the jurisdiction that you're in, that you're paying tax in when you have the capital gain. So if you were a US taxpayer and now you move overseas and you pay tax overseas and you have this gain, even though it would be QSBS excluded in the US, but if you're now paying tax elsewhere, you may be subject to capital gains there.
Thank you, Jonathan. There are some questions specifically related to the example you just gave. I was wondering maybe we can just quickly address those, right? We only
Sure.
have 40 minutes left, so please be very concise about answers so we can get to as many questions as we can. So the last example, a couple questions. One is actually in terms of the 2 million, someone is asking why the 2 million doesn't need to be held for 5 years, or if I missed anything.
Well, why does that need to? Well, it's the exclusion is on a per issuer basis. So it's that the exclusion level is determined based on your basis in that issuer. And so the issuer being the company that you held stock in. It's I guess a bit of a two-part question, but it's really the exclusion level that's being determined based on the basis that you have in that company. And so I'll circle back.
Jonathan, maybe let me ask it this way, Jonathan. So for that 2 million to be qualified for QSBS, I understand the calculation is based on how much you hold, But for that 2 million to be eligible for QSBS, or at the time of tax filing, does the investor have to hold this for 5 years or no?
Let me circle back with you on that. My understanding is that the basis is ultimately so you need to have held equity in the company for 5 years. Well, that's correct. Which in this case, a portion of the equity was held for 5 years. A portion of it wasn't, but that contributes to the ultimate exclusion level. So effectively, it is doing the same thing. I see that, where it's a certain amount of the equity is not meeting that 5-year holding period. But let me circle back with you about making sure that I mean, from everything we know, that is the case, and how the exclusion level is taken into account. But I'll circle back with you about more details about that question.
Got it. Thank you. There's another question. Again, let's be kind of concise about it. The answers. Can you clarify step 2 in the calculation on the slide that says cost basis for all QSBS stock in the same issuer, regardless of whether the stock was held for 5 years?
Yeah, so that's exactly what I was just saying. That like the basis used in your exclusion percent or exclusion amount, the 10 million or 10 times your cost basis, is the 10 times your cost basis is generally based on all the QSBS stock that you hold in that company. And it's gained notoriety. There's a term called packing regarding ways to increase your basis in a company to up your exclusion level, and it's the same kind of principle.
Yeah. So thank you, Jonathan. Just for audience, we're going to come back to confirm that. But again, please consult your personal tax advisors for the exact answers as well. All right. There's another question here very quickly. What happens if a company does not take a position on QSBS eligibility, but instead refers an investor to consult his or her tax advisor? In other words, if there's no legal opinion on QSBS, or does the company have to do anything to prove the stock they issued is QSBS eligible for the investor to take advantage of the tax benefit?
Yeah, that's an interesting question that we're often asked. That there's no reporting requirement for companies currently to the Treasury or the IRS regarding stock qualifying as QSBS. It's interesting. In Europe, or in the UK rather, there's a similar tax provision incentivizing investments in early stage companies, and there the companies are required to get pre-certified as being eligible. So while over in the UK, it is the case that you have to be pre-approved. In the US, there's no pre-approval, and there's also no corporate reporting requirement. That said, there's a requirement in Section 1202 that says if the IRS or the Treasury asks a company to substantiate eligibility of their company, that the company is required to, or agrees to, submit a report to the Treasury, but there's no current reporting or current reporting requirement. So what do you do in that situation? And that's often a challenge. It's QSBS creates this kind of huge data challenge, because you need to demonstrate that the company met certain eligibility requirements, and so you can't always do that if you don't have access to the data, from the company. And so we've worked with individuals where piece together, well, what can be demonstrated, and what questions remain, or what areas were you unable to substantiate, to at least show a good faith effort in demonstrating that all the criteria were met.
Yeah, thank you, Jonathan. So just to summarize, first of all, for investors, please do not wait for the company I think anytime you invest, try to get a legal opinion from a company or a third-party services like Jonathan's to kind of at least give you a guideline. A lot of investors actually at the time of exit, they go back to the company to ask for that. And the company at the time of exit, they start to kind of demonstrate they are QSBS eligible. That's always the last thing you wanted to do. If you can get a QSBS, some kind of confirmation or some kind of legal opinion, definitely do that at the time of investing, not at the time of exit. So Jonathan, can you just move to the next slide? And we have a lot of questions regarding the corporate eligibility. I think a lot of founders, a lot of I think company entrepreneurs in an audience, they wanted to know a lot of the kind of insights from you regarding how are a company qualify, stocks they issue qualify for QSBS. Can you go through that?
Sure. So in terms of eligibility, the way it generally works. So up top here we have, so look at this as a whole timeline of the company's existence. So, and for a particular security, once it's issued, if it has to be held 5 years for it to be QSBS eligible. If it's sold prior to the 5 years, there's a sister provision of QSBS as long as the security was held at least 6 months. If there's an exit before the 5 years is met, there's what's called you could roll the gain into other QSBS stock, and we'll touch more on this later. But there are nuances about that. You have 60 days to do it. But let's touch on the actual requirements. Like, what does it take to be QSBS eligible? So and the way that we look at this is both at the taxpayer level and at the corporate level. So in terms of the taxpayer level, so the taxpayer must have acquired the stock at original issuance, meaning directly from the company. Doesn't mean, often we're asked, well, is that only when the company was founded? No, it's any equity issued directly by the company as opposed to getting it from another shareholder through a secondary sale. Then secondarily, there's a stock redemption provision where if the company buys back your stock as an individual within either 2 years after it was issued, or if they redeem other stock from you that you held 2 years before this stock's issued, that jeopardizes all your stock from qualifying. There's a de minimis level which has to be taken into account, but be aware of the redemption provision. And so that exists at the individual taxpayer level and then also at the corporate level. So we'll get to that. So for a corporation, in order to qualify, the corporation has to be a qualified small business. So what's entailed there is that the entity is a domestic U.S. C Corp with less than $50 million in gross assets. It's really aggregate gross assets because it includes other entities that need to be aggregated with the entity, subsidiaries, affiliates. And so I know before there was a question about what does it mean to be a domestic U.S. company. And so if you think about it at the extreme, this isn't, there's an exclusion written into Section 1202 about shell companies. So if you're a foreign company that sets up a U.S. C Corp just to raise money in the U.S., the QSBS isn't really meant for that type of entity. So that security. So, and at the other extreme is a company it's a U.S. registered company and all the operations are in the U.S. So which clearly isn't a problem. So it's there's gray area with a lot of QSBS items, and that's one as well, is to how much operations need to be in the US, or how much of the company's assets need to be. So the next part of the requirement is from when the stock's issued all the way through your holding period. And this is called the active business requirement. And so this entails, firstly, that you're in a qualified trader business. I know there are a lot of questions asked about certain types of businesses and do they qualify? And that's really like the biggest area that the IRS has weighed in on with private letter rulings as to, does a business meet the requirements of being a qualified trade to begin with. The other area of the active business requirement is really how the assets are utilized. And so basically during a holder's holding period, for substantially all of your holding period, which is thought to be at least 80% of your holding period, the company has to demonstrate that there are three metrics-based tests basically to demonstrate how the assets of the business are applied to a qualified trader business. And there are certain limitations or things that the company can't do, like investing in other company stock. There's a limitation on how much you could do of that, or if the company invests in real estate that's not used in the primary operations of the business, there's a limitation on how much of that you could do as well. And then in terms of the stock redemptions or buybacks by the company of their own stock, there's a significant stock redemption clause where if the company buys back a significant amount of stock, again, this is over a de minimis threshold, within a year before or a year after a stock's issued, that could limit any stock that was issued within a year of that redemption from qualifying. And so probably the most common time we see this come up is, say a company does their Series A round, and then a few months later says, oh, well, our founding team has been working so hard all these years to develop this company. Now that we have cash, let's buy back some of their stock to reward them for their efforts. And, not realizing that buyback of that stock is, from QSBS purposes, a significant stock redemption and jeopardizes the eligibility of those A shares and other shares that were issued in that year before or year after the redemption.
Yeah. Thank you, Jonathan. There are a number of questions here. Just let's get to it very quickly. One is, it seems like some investors or audience entrepreneurs have some confusion about the 50 million number, right? And so can you explain, so people are confused out with valuation, but this is actually, you talked about aggregate gross asset, and some people understand it's net asset. Can you actually explain a couple of things, right? What that 50 million really is? And can the DAB be deducted from that kind of gross asset, or kind of, is it gross asset or net asset?
Yeah, so let me, it's a good segue to the next slide, which is an example of how gross assets are calculated for this purpose. So, the term is interesting. So like, what is aggregate gross assets? So firstly, the aggregate really refers to which entities are aggregated for this quantification of gross assets. So if you have a parent that has a subsidiary, that you'd aggregate that subsidiary if the parent owns more than 50% of the subsidiary by voter value. And similarly, if you had equity in the subsidiary and there's a parent entity, you also have to consider aggregating the parent in certain situations. Then what's the term gross in this case? So we'll get to that as well, but gross versus net. the way I think about it, gross in this context really it's gross. It's gross of liabilities. So it's saying your assets, gross of your liabilities, not necessarily gross of, say, depreciation on assets. So it's easiest to walk through an example. So let's get into it. So here's a company we looked at where what happened. So gross assets in 2015 were well below the $50 million threshold, which is demonstrated by this red dotted line. By 2016, by the end of 2016, the assets were above 50 million. But what happened, there was a financing round during 2016. And so what we're trying to do is quantify the assets at that time. So one way to go about that is, well, start with the assets, the aggregate gross assets at the end of 2015. You could roll forward net income. It's imperfect, we're making the assumption that income is spread evenly throughout the year, but trying to quantify, well, what would the assets be at that point in time? So adding in that portion of net income. Now, here's one of the areas where the gross versus net in terms of assets comes into play. This company has a good amount of equipment. And so suppose it was $40 or $50 million worth of equipment. In this case, it's net of tax depreciation, so which is accelerated on equipment. So we're taking the equipment net of tax depreciation. Other assets there, maybe there were assets that were contributed. In the case with QSBS, contributed assets to an organization need to be included at fair value. So not cost in that case, but that's really the one time where the value of assets really comes into play, is if assets were contributed to an organization. Otherwise, we're talking really about the tax basis of assets, or basically the book value. But there could be other questions here that companies look into. How collectible are receivables? Should receivables be written off? Should assets that aren't being used be disposed of? Maybe we've seen several situations where maybe instead of the company obtaining a loan and having cash on their books, they could consider a line of credit to only draw down, when they need the money. All ways to think about, keeping your asset level below 50 million, and then so in this situation, so suppose the Series A round was 20 million in total, these two orange bars. But what one question here is, well, could the round be completed in several tranches? And so the first tranche could potentially keep their securities below the 50 million, whereas suppose at some point later close the second part of the round, and maybe the assets are above 50 million, maybe they spent it down, and so that those securities could still be below the 50 million as well. So Lishang, I don't know if that addressed all the questions that people had about how this is quantified, but any others that you want to address? You're muted.
Thank you, Jonathan. I think this addresses a lot of questions, but we'll continue to monitor the Q&A box and to see if there's any relevant questions here. And there are a couple other questions regarding eligibility. One is a service company, and one question is whether service company would also qualify for QSBS. My understanding is that doesn't differentiate the tech companies or service company. Can you just comment on it?
Yeah. So that's often brought up as well. Is there's within the Section 1202, there's a lot of discussion about services businesses, but And one way, or the way I think about it is, if the business is really driven by the type of service, is say like a professional service, a CPA operating as a CPA, a doctor providing services to patients as a doctor, where the individual is the main source of revenue, because of their credentials. That those types of businesses tend not to qualify as QSBS from a services standpoint. Other services businesses that are C corps that don't require specialized skills would generally qualify. People also ask the same thing about SaaS businesses, software as a service. It's for the most part, SaaS businesses would generally qualify.
So there's also a question regarding the SEC, kind of security kind of type of tokens. Do they qualify for QSBS if investor investing in SEC kind of filed token, which means that they are securities? I mean, do they also get tax benefit for QSBS?
Well, that's an interesting question. We haven't gotten that one yet. But there are certainly a lot of types of securities that have been introduced since 1993 when the QSBS was created. And in the next section, we're going to get into some of the nuances of the different types of securities. So we could revisit that there with those. But generally, QSBS is meant for originally issued equity from the company. So so if the token, if underlying the token is originally issued equity, the original holder would likely be sitting with QSBS stock. If a secondary sale happened and now another purchaser of that token has the security that they got from this other holder, I would tend to think that in their hands it wouldn't be QSBS, although that's certainly one of these questioned areas within QSBS, who holds the originally issued stock.
Yeah. Thank you, Jonathan. Again, for specific answers, I think we do suggest you consult your personal tax advisor. And I think most of the questions in the Q&A box are related to the third pillar, which is the taxpayers implication. So can we just go through on these slides very quickly, because we only have 15 minutes left. Let's go through that, and I'll raise some questions that are not covered by the slide.
Sure. So a lot of those questions are centered around the different types of securities. And so going back to this timeline of eligibility, if we look at different types of securities, and what we're really trying to assess is, when does the QSBS holding period start for those securities? So in the case of stock options, it's not when the options are granted or awarded, it's when they're exercised. Some companies allow early exercise of options, which allows individuals to start their QSBS clock, when they exercise them. If we skip a convertible notes, are generally thought to be a more of a debt security. So the QSBS holding period doesn't start when the convertible note is issued, but rather not until it converts to equity. Restricted stock units and restricted stock awards, it's those have vesting provisions where generally if you file an 83B election, that would allow you to start the QSBS clock when the 83B election's filed. Otherwise, the holding period wouldn't start from a QSBS standpoint until the shares are vested. With common and preferred equity, the holding period, generally starts directly when they're issued. And for safes, we get a lot of questions about safes, and it's another type of this another security that was created after QSBS was invented, and it's not while it has some of the same mechanisms of convertible debt, there's no actual debt. Is it debt? Is it equity? There are attorneys who take differing views on whether the holding period should start when the safe was issued versus when it was converted to equity. And even Y Combinator in the safe templates, the most recent one has a footnote saying that it's intended to qualify as equity for Section 1202 purposes. So that said, it's certainly a debated area, and one that we could discuss with individuals further about their particular situation. And I would say as well, with all these securities, like when you think about the holding period, like when the holding period starts, it's also the case that the company needs to be a qualified small business at the time the holding period for QSBS purposes starts. So with stock options, if you exercise them after the company is no longer a qualified small business, say you exercise after the company has $50 million in gross assets, that stock in your hands is not going to qualify as QSBS. Before moving on from there, Sheng, any other questions with securities?
Yeah, there are a lot of questions from founders and entrepreneurs who either had an exit or going to have an exit. And there are a lot of questions about their founders' stock and employee stock, and how do they take advantage of the benefit in terms of the holding period. And there's a lot of very specific questions. Maybe you can generally talk about, for founders and employees, how do they best take advantage of the QSBS?
Yeah, well, I mean, founders generally get their stock before anybody, so have the most chance of meeting the 5-year holding period, and also meeting all the requirements, when stock's issued for it to be QSBS. There are certainly situations that we've run into where founders made S elections, or the company made an S election early on, when the founder stock was issued, and which is problematic for those founder shares. So there are many situations to consider. In general, maybe this is a good kind of segue to our next area with the rollovers, but if we have a lot of situations where if a founder or company is sold prior to the 5 years being met, a lot of founders approach us about, okay, what do they do? And the QSBS Section 1045 rollovers provide a great opportunity for an entrepreneur to roll their gains into a new business. If they're thinking about starting a new business already, now this could be some of the capital to help make that happen. So should we move over into rollovers, Sheng?
Yeah, another quick question. Does anything other than C Corp qualify for QSBS, like B Corp? Would that qualify, or S Corp?
Yeah, well, so you really have to be taxed as a C Corp. So if you're an LLC taxed as a C Corp when stock's issued, that's generally fine as well. A B Corp is really, or public benefit corp, is in a way a subset of a C Corp, but it's still an entity that's taxed as a C Corp. So that's generally fine as well, and doesn't impact eligibility. An S election, on the other hand, changes how the entity's taxed, where the entity becomes taxed as a pass-through entity, and that is problematic from a QSBS perspective, where stock issued when the company is an S corp isn't going to qualify.
All right. Yeah, please continue.
So looking, deeper at Section 1045 rollovers. So we have the rule up at the top, but so if you've held stock for more than 6 months, but you don't sell it before the 5 years is met, before the 5-year holding period is met, you have the opportunity to roll it into other QSBS stock. So suppose when an investor first invests in a biotech company, in this case, biotech company, the stock qualifies as would be QSBS. Now, say 3 years later, the biotech company offers a secondary sale opportunity, and the investor sells their stock. So now they have a gain that would have been QSBS eligible if it met the 5-year holding period, but in this case hasn't. So now they have 60 days to roll that gain into another qualified small business stock. And as I was saying, when we talk to entrepreneurs, many of them, want to start another business and roll their gain into, or roll their sale proceeds into that new business. But investors, tend to look for other investments. And one of the exciting ways to do that, could certainly be through PropelX and, investment platforms like PropelX. So, where there are a lot of companies raising capital, at various times, and, it could make identification of these rollover eligible companies, easier to identify. So generally it has to be direct equity. So companies raising a priced round. And so now you make that rollover. Now, suppose you hold that security for another 2 years and have a realized gain. Now, the combination of the first 3 years plus the 2 years of holding the second company, now you've met the 5 years. And so long as both companies are indeed eligible qualified small business stock, you could you had first rolled your gain, and you have to report the rollover when you make that rollover investment in that tax year. But now you have this gain, and you report it as a QSBS gain when you file your taxes. And so, from a reporting standpoint, you do want to make sure that you could substantiate that both stocks were QSBS in your hands, and that's certainly where we could be of help.
Yeah, there is a specific question about where can investors who have a roll of funds find the eligible opportunities. One good news is PropelX and the Cap Gains have started collaborating on some of the opportunities on the PropelX platform, whereby the companies or the startups would use QSBS service to be able to tell investors that this company, we've done analysis on this company, the company is very likely to be qualified for QSBS. And if you have funds to roll over to the next investment, here are a few things I wanted to maybe tell you about as kind of tips. If you're a founder or investor, you have funds to roll over. First of all, don't start when there's only a few days left. There are a number of reasons for it, right? If there's only a few days left, then you don't necessarily have the time to perform diligence in the opportunities. And second of all, even if you find a good opportunity, that doesn't mean that round will be closed, right? In your kind of the clock before the clock ends. So one thing I wanted to let you guys know is that if you do have upcoming roll funds that you're anticipating an exit, you probably should look into opportunities on platforms like Propellex that and are on QSBS eligible. You start to look into these well ahead of time, right? And first of all, give you time to do diligence. And Propellex, we do have broker reviews, which is a very thorough diligence report on the companies on compliance and financials and legality and things like that, right? We also do background checks on founders. And second of all, that just gives you a lot of cushion, because typically raising a equity round is not like a safe or convertible note round, right? Only equity, we heard Jonathan talked about, only equity are immediately eligible for QSBS. But the problem with equity round is actually it does take time to close. Versus safe and convertible, you can do rolling close. So they can actually, the company can get the money in anytime. But for equity, it does take time to close. Therefore, I think when you look at these opportunities, you want to make sure that you do that ahead of time and start looking into opportunities. And also, diligence takes time, right? I will not encourage investors to roll over their fund just for the sake of rolling over, because investing any early stage company can be risky, right? So that's your trade-off. You're thinking, well, do I want to maybe roll over my $200,000 gain into a company that could potentially fail? Or maybe I roll over a portion of that, right? And versus maybe I pay capital gain tax. So that's a kind of a conscious kind of calculation you have to do, personally. Therefore, the more time you have to perform diligence, the better, right? You can actually have a really understanding of that risk. So that's what I wanted to say. If you have rollover funds qualify for QSBS.
Yeah, and I would just say that's consistent with what we hear from folks that, when investors have these rollover gains, a lot of times they're looking for what's a company that is more proven out, that they're not necessarily taking the same risk that they did in that first company, and that you want to moderate your risk as much as you can in a lot of ways and find a company that qualifies as QSBS but is more proven out, depending on how willing you are to risk that capital.
Yeah, and there's also a specific question about the any special document, not safe, but maybe slightly more similar to safe than equity, but can be more friendly for QSBS eligibility. Personally, I haven't seen a lot, but most recently we've seen one type of a vehicle called the Convertible Equity Instrument, CEI. It's similar to a safe, but it actually qualifies for QSBS. But I haven't seen a lot of companies take advantage of that. Don't know the reason why. But I think that's the type of instrument you can look into. It's very similar to safe. A company can roll in close on that document, but that document is very QSBS friendly. There are a couple other questions regarding whether SPV qualifies for QSBS. SPV is a pass-through instrument, pass-through entity. Therefore, as long as the underlying investment qualifies for QSBS, SPV investors should be able to benefit from QSBS eligibility. And there are a lot of, I think, questions are really, I think, very specific. It's very hard to address on this call. I think if any of you have questions that are really burning, or you really wanted to know the question or the answers as soon as possible, really let us know. You can shoot an email to investors@propellex.com, or you can shoot an email to Jonathan. I think his contact info is at on the front page. We're going to share the slide deck as well after the call, and also we're going to do compliance reviews on this recording. Once it's approved, we'll share the video with you as well, right? And one question, Jonathan, before we wrap up, is about the reference and any other useful sites that teaches or collects a lot of knowledge about the QSBS. You can share with the audience so that they can do a little deep dive in this topic.
Well, could always give a shameless plug to our site, qsbsexpert.com. So we've pulled in a lot of research and a lot of thought from others that publish data about QSBS and thoughts, and so definitely come feel free to come visit us. Otherwise, there are some attorneys out there and accounting firms that put out various information, that is useful. Wealth managers who do the same. Like, QSBS touches on a lot of disciplines and areas, like I was saying, and tax and estate planning. So generally, firms that focus on those different areas put out various information about QSBS and could address it from different perspectives and different ways to think about how to plan in your particular situation.
Well, thank you, Jonathan. I think just for audience, we're going to try to come back with the answers to the questions that are still outstanding. And there are a couple of follow-up items. One is, I think Jonathan is going to confirm in terms of, hey, if there are multiple investments an investor did, or, there are stock issued to someone at different time, if the first portion has met 5-year holding period, would that cost base or the tax base be the entire investment? And that is one thing that we're going to come back to you with. The second thing is, I think that there's some question, Johnson, about the 10x versus, I think the 10 million versus the, is that 10 million versus, is that 10x, or there is a minimum and maximum of between the two? I think there's some confusion about, what is that a minimum of the two, or is that the max of the two?
Well, just real quick, it's the max, between the two. But that relates to the previous question you mentioned, and so we're happy to pull more materials together on that whole area, and we'll work with you to get that out to everyone.
Well, thank you so much, Jonathan, for your knowledge and insight and all the work that you put together in these slides to address our investors' question, our audience question. And thank you, everyone, for joining us today. I know this is a kind of deep topic. There are a lot of stuff that's out there we haven't covered. So as I mentioned, if you have any questions, feel free to reach out to us, right? We can either address your question directly, or we can pass on the question to Jonathan, or maybe have another follow-on webinar if we see there's a need for it. All right. Well, with that, I'm going to conclude this webinar. Thank you so much for participating today. Have a wonderful weekend.
All right. Thank you. Thanks, everyone.